Just want to provide a quick update on the day late dollar richer model. So as a reminder, that's following along the issuance, 1/100,000th of the issuance of ProShares product SQQQ, which is the most profitable product currently. When I say most profitable, I'm speaking it through the viewpoint of Wall Street and through ProShares. So it's the most profitable leverage exchange traded product that is currently traded. Gross returns are around $14 billion, currently around $3 billion in net assets for that product. Highly, highly profitable. Been around since 2010, so just hit 15 years. So let's check the model real quick, and then we'll kind of confirm it with the historical NAV information. So day late dollar richer. We'll see where we're at. So since 3/12, we have made 1/100,000th of the issuance following along, not trading on any specific time, just making sure that we follow sometime throughout the day. Total P&L is a $1,500 gain. That's 10% of the current amount outstanding. Currently short 453 shares. And then the trade data here. So we have our long positions, our short positions. On the long side, we can see the dates and then my trade executions. Once again, I'm not trading at the open or at the close. I'm just throughout the day. I am of the mindset this all averages out over time. I do this consistently. So I just put in a market order after I check the data at some point. So one interesting thing of note is we had the first redemption for SQQQ since 4/21. So it's been, well, I guess the date would be 4/20. We're trading a day late. But it's been a long time since that ETF has not issued shares, which happened daily up until 2 days ago, where the share count stayed flat, and now we have a share count reduction. So, I'm of the thought if this continues, we can expect this product to go higher, because if the counterparties, the Wall Street counterparties who are on the other side of the swap agreements that are providing the leverage factor for this product, it stands to reason that if this product skyrockets, they would lose a substantial amount of money, potentially with no backing, and that would be bad. So I just take the mindset of following incentives. Once again, I believe this lends to the fact that following along the issuance of these products, even when you do it in aggregate for all ProShares products, and then further expand it to all leverage exchange traded products, when you follow along the issuance and you trade along in proportion, you'll crush the market's returns. You'll do so with less volatility. I don't know how to make it any more simple than that. You don't even need to count cards. We're just following the casino on a daily basis. What I just said only works, in my mind, if these products are design structured fraud. So that certainly lends to that fact. It certainly warrants evidence that when that fact is validated that I just said, which will happen publicly by people other than me over time, because it is a fact, but it's a very dangerous thing to claim, because if that fact is true, there's a major, major problem that needs to be addressed, because we're not just talking about now hundreds of billions of dollars of product that has been priced off of mathematics. When you look at the private markets, when you look at everything that Wall Street issues, it's definitely the majority of the new issuance of products, and it's going to raise some major red flags. So keep it in the back of your mind now. I'm positive you'll hear about it in the future. But if we would have done that 69 shares purchased today, bought to cover in my account, executed that at 29.19. It's currently at 29.11, so down a little bit on that one position. And then we look at the short positions throughout time, and we can kind of see where the gain losses are. So some pretty hefty gains there. In fact, every time the issuance happened since 5/12, we're seeing some gains, right? And some of these are pretty large, 43% on that one. That's not bad, 57 shares. So once again, follow along if you'd wish. Let's validate that now off of a spreadsheet here. So here's the spreadsheet I pull straight from ProShares on a daily basis. It's historical NAV. I've gone over and walked through that process before. All I'm looking at is the shares outstanding, the delta change. So how many shares on 5.6 versus how many shares on 5.7. So we just go equals how many shares on 5.7 minus how many shares were at 5.6. This tells us if there was an additional shares or issued or a reduction of shares, meaning that there was a redemption here. Remember, this is the thousandth of the share count. So we have 6,900,000 shares that were redeemed on 5.7 versus 5.6. I'm doing 1/100,000th, so I just take this number, divide it by 100, and that means 69 shares. When it's a negative, I buy, and when it's a larger number, meaning the share count went up, I sell short. I'm just following along with the issuance. So if you're interested, currently this model is priced at $5 a month. Just to follow along, you can pull it up on your own, do whatever you want. But if you want to follow along, it's currently listed at $5 a month. My goal in all of this is not to make money off of $5 subscriptions here and there. Obviously, that's a waste of everyone's time and effort, and the alpha I'm giving away here is worth far more than that. As you know, I'm a whistleblower. I believe that these and other financial products were designed as structured fraud, and that it's not individuals that are making the decision to purchase these on their own, like walking into a casino. The vast majority of these assets is funneled through managed money, meaning that the people who have exposure to these products do not know it, they did not approve it, and it breaches fiduciary responsibility. This is something that'll come out more in public soon, because I'll make sure it does, and something you should keep in the back of your mind as well. I'm going to do a free code for this for anybody in the past who's bought the book Structured Fraud, has my whistleblower complaints, also has several models that beat the market mathematically over time, essentially card counting. Exact same claim. If you believe card counting can happen in single deck blackjack, what I am saying is nothing different. Casino games are built off of gambling mathematics to make sure that the casino wins on average over time. Structured products are created to ensure that Wall Street wins with no risk over time, and that means that you lose. Because these products, the vast majority of the assets in these products never invest in anything underlying, simply swap agreements. It means that the money that it's taken from investors that is set to decline over time means that it's passed back and forth between the issuer, the swap counterparties, and the distribution chain, meaning it just stays with Wall Street, it doesn't leave it. So I think that's wrong. I think that's fraud, and I think eventually other people will think that as well. No one really turns a blind eye. Everyone turns a blind eye to fraud until you can't anymore. So I'm of the firm belief that it takes a long time and likely the collapse of a fraud to actually get anyone to care. But eventually, when people realize it's so much profitable to follow along the mathematics the way I do, the way I've written, the way I've published, the way I've given the SEC for years, I think it will become undeniable. All the flow of money will eventually bet against these products. There'll be no more individuals willing to buy them on the long end because it's so much more profitable to sell them short, bet against them, buy puts, sell deep in the money calls, buy put spreads, sell call spreads, things that do not have borrow fees, to bet against these products until they go into oblivion. Once they go into oblivion, the questions will be asked, well, these products were obviously designed mathematically to decline over time. Who lost money? And then you start looking at the 401k, the endowment funds, the foundations, the other managed money. Sovereign wealth funds are a giant one that have these products that the underlying holders didn't make that decision. And then it will be, how was this facilitated? What duties were breached? What ERISA guidelines were breached? The fiduciary responsibility, and then the warnings in the prospectus that say don't hold these longer than a day. All the things that were violated to have money lost by a set of investors for the profit of Wall Street. Once again, it's an inevitability. It's a race to the bottom. I will not stop saying that. I've been saying the same thing for 5 years. I'm not an Anon account. My name's right here. Eventually, it will hold true. If I was wrong, I would have shut up years ago. It would have taken one one message from somebody who knew mathematics and said, hey, you're really making a fool out of yourself. Here's where you're wrong. It won't happen because it's math, it's right, and it will be validated. And when it is validated by someone that has a voice, the rest of the world will catch on and agree quickly. There are now people on Wall Street who are now writing articles about beating these products. Definitely, I mean, they're not listing their methodology, but I've been doing that for several years, published. So now that Wall Street's starting to admit that these profits can be bet against for profit, it's a race to the bottom. So I'm giving the push. Follow along if you want. Dashboard's there. No risk to yourself. Hope you enjoy the video, and we'll talk later. Cheers.